Welcome to the HOTMA Income and Assets Training Series. HOTMA stands for the Housing Opportunity Through Modernization Act of 2016. This law made several changes to HUD's rental assistance programs, including changes to rules for income determination and program eligibility for the Housing Choice Voucher and public housing programs, among other HUD-assisted programs. This series is meant to support public housing agencies in implementing rule changes related to determining income and assets for families in the public housing and housing choice voucher programs. This is the second training in the series and focuses on the implementation of HOTMA sections 102 and 104, which are primarily related to income calculations and reviews, including assets and the asset limitation. My name is Phil Stump-Kennedy, and I am a part of a team of HUD technical assistance providers from NowCap, the National Association of Latino Community Asset Builders. We have been working with HUD to create this training series. HUD staff will be available for questions at the end of the training. There are 3 trainings in this series related to new rules required by HOTMA. There are also related fact sheets and products available on the HUD Exchange. If you missed the first training on Section 103 over income public housing families, or would like to access the related resources, you can access them through the HOTMA landing page on the HUD Exchange. This training and the next one cover Sections 102 and 104 of HOTMA and are related to income and assets. Recordings of the trainings will be posted on HUD Exchange later, and the related resources are available now, and the link to those, including the slides, will be posted in the chat.
My name is Farah Fossé, and I'm also part of the NowCap team. Sections 102, 103, and 104 of HOTMA make significant changes to the U.S. Housing Act of 1937, particularly those affecting income calculations and reviews. Section 102 changes requirements related to income reviews for public housing and the Housing Choice Voucher Program. Section 103 modifies the continued occupancy standards of public housing residents whose income has grown over the over-income limit. And Section 104 sets maximum limits on the assets that families residing in public housing and the Housing Choice Voucher Program may have.
Sections 102 and 104 revise the listed sections of the Code of Federal Regulations, the CFR. We will go through each of these, and you will see the relevant section of the CFR listed on the bottom right corner of each slide. This chart and the CFR notations are here for your reference if you choose to download the slides later, or now as they are now available. We will cover specifics related to assets together as we move into Section 104.
This training will cover the following subjects: income inclusions and exclusions, the earned income disregard, deductions, and the hardship exemptions for certain expenses.
Before getting into the details, let's review some key points. First, the definition of income is changing. Under the new rule, it is defined broadly with enumerated exceptions. The earned income disregard is being phased out. Income deductions are changing, including an increase in the standard deduction for elderly and disabled families. Health and medical deductions may be taken for expenses over 10% of annual family income. This change will be phased in over 2 years. Finally, there's also a general hardship for health and medical expenses and a hardship exemption for childcare expenses.
Implementation of Sections 102 and 104. PHAs are affected by the final rule, which amends 24 CFR Part 5, general HUD requirements, including definitions and income determinations, and more. Again, you can refer to the chart on slide 4 or the notations on each slide to find the specific CFR references. The effective date for Sections 102 and 104 is January 1st, 2024, which means transactions that are effective on January 1st or later need to reflect the new policies. The PHA must update its administrative plan and/or administrative and continued occupancy policy to reflect its discretionary policies by this date. Forms and related systems must also be updated to reflect revisions made effective by the final rule.
We will now discuss the new definition of income, what is included as income, and highlight important changes related to income and inclusions. Income is defined as all amounts not specifically excluded, received from all sources by each household member who is 18 years of age or older, or the head of household or spouse of the head of household of any age, plus unearned income by or on behalf of each minor dependent, actual income from assets, and the imputed return on assets over $50,000 if the actual return cannot be determined. We will cover assets more in depth in part 2 of this training.
HOTMA significantly revises the annual income regulations. The new rule removes the examples of included income sources and provides a broader definition of income. Instead of included income sources, the rule provides an expanded and clarified list of income exclusions.
Earned income is defined as income or earnings from wages, tips, salaries, or other employee compensation, and net income from self-employment. The following new definitions are meant to clarify income that should be included, even if the source, date, or amount of the income varies. An independent contractor is an individual who qualifies as an independent contractor instead of an employee in accordance with the Internal Revenue Code, and whose earnings are consequently subject to the self-employment tax. In general, an individual is an independent contractor if the payer has the right to control or direct only the result of the work and not what will be done and how it will be done. A day laborer is an individual hired and paid one day at a time without an agreement that the individual will be hired or work again in the future. A seasonal worker is an individual who is hired into a short-term position and the employment begins about the same time each year, such as summer or winter. Typically, the individual is hired to address seasonal demands that arise for the particular employer or industry.
This expanded definition of earned income specifies that the following are not considered earned income: any pension or annuity, transfer payments, payments or income received where no goods or services were offered, including welfare, Social Security, and government subsidies for certain benefits, and any cash or in-kind benefits.
We'll now move to income exclusions. Remember, as we go along, you can put your questions in the chat to the moderator, and we will cover as many questions as we can at the end. Generally, all income is included unless it is specifically excluded. Many exclusions are listed in HUD's regulations. HUD will publish additional exclusions required by federal law in a separate Federal Register notice. We have created an income and income exclusions resource sheet, which lists and explains all exclusions provided in the regulation. That is available on the HUD Exchange now, on the link that was previously put in the chat.
We will highlight some notable changes to the income exclusions rule in the next slides. As mentioned, you can see the income and income exclusions resource sheet for a complete list. Non-reoccurring income is excluded. This is defined as income received in the previous year that will not be repeated. Some examples of non-reoccurring income are payments from the U.S. Census Bureau for employment relating to the decennial census or the American Community Survey, and lasting no longer than 180 days and not culminating in permanent employment. Direct federal or state payments intended for economic stimulus or recovery. Amounts directly received by the family as a result of state refundable tax credits or state tax refunds at the time they are received. Amounts directly received by the family as a result of federal refundable tax credits and federal tax refunds at the time they are received. Gifts for holidays, birthdays, or other significant life events or milestones. For example, wedding gifts, baby showers, and anniversaries. Non-monetary in-kind donations, such as food, clothing, or toiletries received from a food bank or similar organization. And lump sum additions to family net assets, including but not limited to lottery or other contest winnings. As mentioned above, earnings as an independent contractor, day laborer, or seasonal worker are considered income.
The exclusion of payments from states to allow families to keep individuals with disabilities living at home is expanded. For families who already are receiving an exclusion from income such as payments, for such payments, there is not going to be any change. but additional families will now qualify. The requirement that these payments offset the cost of services or equipment has been eliminated. And HUD is expanding the exclusion to cover all payments by the state Medicaid managed care system or other state agency or authorized entity for caregiving services to enable a family member with a disability to live in the assisted unit.
Trust distributions. Any distributions of a trust principal, regardless of whether the trust is revocable or irrevocable, are excluded. Distributions of income on the trust principal used to pay the costs of health and medical care expenses for a minor are also excluded.
Payments related to aid and attendance for veterans under 38 U.S. Code 1521 will be excluded.
There are also a number of changes related to the exclusion of student financial assistance. The rule creates two categories of excluded financial assistance. The first category codifies a federally mandated income exclusion for financial assistance to students under Section 479B of the Higher Education Act of 1965, as amended. This includes all Bureau of Indian Affairs or Education student assistance programs. For public housing residents, all assistance in this category must be excluded from income. For the Housing Choice Voucher Program, amounts in excess of tuition and required fees are not excluded for participants who are 23 and under or do not have dependent children and are the head of household, co-head, or spouse of the head of household. This applies in years where the HUD Appropriations Act provisions included this limitation, including FY 2022. HUD will notify PHAs if this requirement is removed from the Appropriations Act. The second category, which we'll call Other Student Financial Assistance, may be excluded provided that it is for the actual cost of tuition, books, and supplies, including supplies and equipment to support students with disabilities, for room and board, and other fees required and charged to a student by a higher education institution. This includes the reasonable and actual costs of housing while attending the institution of higher education and not residing in an assisted unit expressly for a student who is not the head of household or their spouse. Excluded assistance in this category must be a grant or scholarship received from the federal government, a state, tribal, or local government, a private foundation registered as a nonprofit, a business entity, or an institution of higher education.
Both categories of student financial assistance exclusions will apply to both full and part-time students. The first category already applied to both full and part-time students. For the second category, HUD believes the exclusion is appropriate regardless of whether the student is full or part-time, given that this financial assistance is limited to costs required and charged to the student by the institution of higher education. For more information, see the Student Aid and Financial Assistance Resource Sheet.
To calculate the student financial assistance exclusion, when a student is receiving assistance from both categories, you will first calculate the actual covered costs. Then apply the Title IV HEA assistance. Subtract the actual covered costs from the total amount of Title IV HEA assistance. If the amount of assistance excluded as Title IV HEA assistance is equal to or exceeds the actual covered costs, none of the assistance included under other student financial assistance would be excluded from income. This is because this assistance would no longer be needed to cover actual costs and therefore would not meet the definition of other student financial assistance. If the amount of Title IV HEA assistance is less than the actual covered costs, then exclude the amount of other student financial assistance up to the amount of the remaining actual covered costs, those costs not covered by the Title IV HEA assistance.
Let's do a knowledge check on calculating the student financial assistance exclusion. We'll take the case of a public housing participant who has received $26,000 in Title IV HEA assistance and $5,000 in other student financial assistance. The student's actual covered costs, that is the costs of their tuition, books, supplies, school housing, etc., comes to $25,000. So question one is, how much total student financial assistance would be excluded? And question two, how much should count as income? You can put your answers in the poll that popped up in the Zoom, or if you're watching a recording or on your phone, you can just write down your answers.
So for question one, the answer is $26,000 of student financial aid assistance. That's answer A, and the poll would be excluded. And that's because all assistance under Title IV HEA assistance must be excluded from income, $26,000 for public housing residents. This exclusion must be taken first. Other student financial assistance could then cover any remaining actual covered costs. Since the actual covered costs come to $25,000, there were no remaining covered costs. Therefore, all of the other student financial aid assistance, $5,000, would be counted as income. So the answer to question 2 is $5,000. Answer C in the poll.
We have another knowledge check question. Which of these would likely be recurring and therefore included as income? A, outreach for the 10-year census. B, seasonal work as a snowplow driver. C, tax credits. D, lottery or other contest winnings. Again, you can enter your answer here in the poll that just popped up on your screen, or write it down or keep it in your mind.
So the answer was B. Seasonal work as a snowplow driver or lifeguard in the summer, for example, would be included as income because it's likely to be reoccurring. The other examples of income are not considered recurring income and would therefore be excluded.
The next up is the earned income disregard. HOTMA eliminated the earned income disregard. As of January 1st, 2024, the EID will be available only to families that are eligible for and already participating in the program, and no new families may be added. Families may continue receiving the benefits of EID until the allowed timeframe expires. So 2 years from the effective date of the final rule, that is January 1st, 2026, no family at all will receive the EID benefit. Families eligible to receive the Jobs Plus earned income disregard pursuant to the FY 2022 NOFO or earlier may continue to receive that disregard under the terms of the NOFO.
Income from assets. In general, income from assets is considered income. Can you go ahead and advance the slide? If it's possible to calculate actual returns from an asset, the PHA should use that amount. If it's not possible to calculate an actual return on an asset, and the net family assets are $50,000 or less, the imputed income from that asset is excluded. If the net family assets are over $50,000, the PHA must impute income for the asset based on the current passbook savings rate, as determined by HUD for any asset where the actual income cannot be calculated. The $50,000 threshold is the amount for 2024 and will be adjusted annually based on the CPIW.
Restrictions based on family assets. HOTMA changes the definition of net family assets to include more exclusions than the previous definition. This will be covered further in part 2 of the training. You can also see the asset resource sheet for the full list of exclusions, which again is on the link that was provided in the chat to the HUD Exchange.
Income deductions. A family's adjusted income is the family income after any deductions as follows. First, mandatory deductions. For dependents, the deduction increases to $480 per dependent. For elderly and disabled families, the deduction is $525 per family. Health and medical expenses and childcare expenses. And also deduct any permissive deductions implemented by the PHA. The deduction amounts for dependents and elderly and disabled families are 2024 figures. These will be adjusted annually for inflation and rounded to the next lowest multiple of $25, so that most years there will not be a change.
Let's look more closely at the deduction for dependents. $480 is deducted for each household member under 18 years of age or attending school or vocational training on a full-time basis, or who is 18 years of age or older and is a person with disabilities. A dependent is not a head of household or his or her spouse or co-head. Again, this number will be adjusted by HUD annually for inflation, according to the CPIW, and rounded to the next lowest multiple of $25. The deduction for qualifying elderly and disabled families is increased to $525 and will also be adjusted for inflation.
Again, the effective date is January 1st, 2024. Health and medical expense deductions. Deductions can now be taken for qualifying deductions over 10% of annual income. This deduction. Qualifying expenses are the sum of the following expenses that exceed 10% of annual income. Unreimbursed health and medical expenses for families with a head, co-head, or spouse who is a person with a disability or aged 62 or older. And unreimbursed reasonable attendant care and auxiliary apparatus expenses for each member of the family who is a person with a disability, to the extent necessary to enable any member of the family, including the person with a disability, to be employed. So the deduction for reasonable attendant care and auxiliary apparatus may not exceed the combined earned income of the adult family members who are able to work.
As mentioned, this is a significant change. This deduction is now limited to the amount by which qualifying expenses exceed 10% of the family's annual income rather than 3%. This increase in non-deductible health and medical expenses, which could result in a significant increase in adjusted income and rent, will be phased in with a hardship deduction over 2 years. For the phase-in, there is a 5% threshold in the first year and a 7.5% threshold in the second year. The increase may also be partially offset by the increased deduction for elderly and disabled families, which is changing from $400 to $525. Given this increase, there are 2 types of hardship exemptions, which we'll go into in the next section. Estimating when to apply the deduction. The income estimation tool may be used with families to estimate at what amount of expenses they would qualify for an income deduction for health and medical expenses. To use the tool, the PHA will input the family's annual income. The tool will then show the amount of unreimbursed expenses, those expenses over 10% of the family's income, that would be needed to qualify for a deduction. This tool can be filled out and given to residents at an income examination so that the resident will know when to see the PHA about a deduction. You can fill in the form and it will calculate the 10% of income, which shows that families with expenses over this amount should seek a deduction. PHAs could choose to complete and print the tool for families to refer to. The tool will also show the amount over 5%. Families who are eligible for a hardship exemption may be able to deduct health and medical expenses exceeding 5% of their income. This will be explained a little later. And this tool is available on that same link on the HUD Exchange. The child care deduction may be taken for any reasonable child care expenses necessary to enable a member of the family to be employed, to further his or her education, or to look for work. There is no threshold amount. However, families cannot deduct more in child care expenses than they earn if the deduction is claimed to allow someone in the family to work. Let's look at an example where a family is receiving a deduction for both childcare and disability assistance expenses. So the head of household's earned income is $15,000. The spouse's earned income is $6,200. So their total income is $21,200. The family has 2 children, a 9-year-old daughter and a 16-year-old son who has a disability. The care provider cares for both children, and she charges $200 per week. The care provider verifies that the cost for caring for the 9-year-old daughter is $125 a week, and the cost for caring for the 16-year-old son is $75 a week. The child care expense enables the spouse to work. Child care expenses come out to $6,500 annually, $125 per week, 52 weeks per year. The total disability assistance expenses are $3,900. That's $75 a week for 52 weeks a year. Any disability expenses over 10% of the family's income can be deducted. So we'll subtract 10% of their income, $2,120, from the total expenses, which are $3,900. Deductible disability expenses come to $1,780. Total deductions for childcare cannot exceed the spouse's employment earnings of $6,200. So we have the childcare deduction capped by earned income at $6,200. Disability assistance deduction, $1,780, and the deductions totaling $7,980. It's worth noting that the disability assistance deductions are also limited.
Assuming the disability assistance enables the head of household to work, the total deductions must not exceed $15,000.
A PHA may adopt additional permissive deductions from annual income through a written policy. However, PHAs will not be eligible for additional HUD funding based on an application of any permissive deduction.
Hardship exemptions. HOTMA specifies 3 types of hardship exemptions, which may allow further income deductions. For unreimbursed health and medical care expenses, there's a phase-in hardship exemption due to the new threshold and a financial hardship exemption. There is also a hardship exemption to continue childcare expenses.
Hardship exemptions for health and medical expenses. The final rule provides 2 types of hardship exemptions for health and medical expenses. The first is the phase-in for families already receiving an exemption, and the second is for any family who can demonstrate a related financial hardship.
So the first category is for families eligible for and taking the unreimbursed health and medical care expenses and reasonable attendant care and auxiliary apparatus expenses deduction in effect prior to the final rule. Relief will be phased in. For the first year, the PHA must deduct eligible expenses exceeding 5% of the family's income. The second year, the PHA must deduct expenses exceeding 7.5% of the family's income. 24 months after the initial relief, the hardship exemption expires. The PHA will then only deduct expenses that exceed 10% of the family's annual income, unless the family qualifies for a new exemption under Category 2. The other deduction may be requested before the end of the 24-month transition period.
The second category recognizes that the change in threshold may result in financial hardship for families who were not receiving the deduction or may not even have been receiving housing assistance at the time this rule went into effect. To be eligible, a family must demonstrate that their health and medical care expenses or reasonable attendant care and auxiliary apparatus expenses increased, or that the hardship is a result of a change in circumstances, as defined by the PHA, that would not otherwise trigger an interim reexamination. The family will receive a deduction for the sum of the eligible expenses that exceed 5% of annual income. Hardship relief ends when the circumstances that made the family eligible for the relief are no longer applicable, or after 90 days, whichever comes earlier. However, the PHA may, at their discretion, extend the relief for 1 or more additional 90-day periods while the family's hardship condition continues.
Here's an example of the hardship deduction for medical expenses. The family has been receiving a health and medical expense deduction for unreimbursed expenses over 3% of their income. The family's income is $20,000. Their unreimbursed qualified expenses are $2,500. 3% of $20,000 is $600. So the previous deduction was $1,900, the amount of expenses over $600. Under the new 10% threshold, they would receive a deduction of $500. With the Category 1 hardship exemption, in year 1, they'll receive a deduction for eligible expenses that exceed 5% of income, so a $1,500 deduction. In year 2, they'll receive a deduction for eligible expenses that exceed 7.5% of income. That's $1,000. And in year 3 onward, they'll receive a deduction of eligible expenses exceeding 10% of income, $500.
Let's look at some examples of hardships qualifying under Category 2. The first example is a family who may have had qualifying medical expenses that did not exceed 3% when the rule went into effect, but whose health and medical care expenses then increased but did not exceed the new 10% threshold. This family will receive temporary hardship relief if their related expenses exceed 5% of the family's income. Another example is where a family's related medical expenses have not increased, but the family has had a decrease in income or increase in other expenses, resulting in a financial hardship. The family will receive a temporary hardship relief if their related expenses exceed 5% of the family's income.
Families may also use a hardship exemption under the second category, following the use of a hardship exemption under the first category. This could be a family who qualified for relief under the first category, but exhausted that relief, or chose to apply for relief under the category in the second year of receiving an exemption under the first category. In the second year, a family would be receiving the exemption for expenses over 7.5%. If they qualify for an exemption under the second category, they would then receive a deduction for expenses over 5%. To be eligible, a family must demonstrate that their applicable expenses increased or that they had a financial hardship due to a change in circumstances beyond the transition to the higher threshold. The exemption may be taken for up to 90 days unless extended. The family would then be subject to the 10% deduction threshold, even if they had not fully transitioned to this threshold under the first category.
The next hardship exemption is childcare expenses. A family whose eligibility for the childcare expense deduction is ending may request a financial hardship exemption to continue the deduction. The family must demonstrate that they are unable to pay their rent because of a loss of this deduction and that the childcare expense is still necessary, even though the family member is no longer employed or furthering education.
The exemption resulting alternative adjusted income calculation must remain in place for up to 90 days. It may be extended at PHA discretion for an additional 90-day periods based on the family circumstances.
Here's an example of when the child care hardship could be used. A family no longer qualifies for the child care deduction because the family member who was employed left their job to provide uncompensated care to an elderly friend who was severely ill. The hardship exemption must remain in place for 90 days and could be extended based on the discretion of the PHA and family circumstances.
Requirements for the child care hardship exemptions. The PHA must have an established policy for determining a family's inability to pay the rent if they request a child care hardship exemption. The family must receive prompt notification in writing of the change in adjusted income and the rent due to the child care hardship exemption and dates for when the hardship exemption will begin and expire.
Now it's time for your questions. We have the team from the HUD Office of Public Housing and Voucher Programs available to take questions. We've been monitoring the questions that have come in the chat and the Q&A, and you can continue to put questions in the Q&A. Moderators are prioritizing questions that are being asked by multiple participants. If we cannot get to your question during the time that we have today, or you have a specific scenario or resonant question, please email hotmaquestions@hud.gov. So I'll turn it over to HUD.
All right, so this is Ashley Matthews from the Office of Public Housing and Voucher Programs, and we are going to go through some of the questions we've gotten with some themes that are appearing a lot. So the first is, you're talking a lot about PHAs and the Housing Choice Voucher Program and public housing, but what about the project-based rental assistance program and HUD's other multifamily programs? So the answer to that is that HOTMA does apply to multifamily programs, but we have in PIH gotten this training specifically for PHAs. So throughout, or it's not always saying like PHAs and multifamily owners, a lot of it applies, but this has been focused on PHAs and sort of how PHAs would think about these things. So I would say stay tuned from HUD on more information on sort of how this applies to the project-based Section 8 program. Okay, let's see, what else do we have? Can you please provide guidance on whether the income of temporarily absent family members is still included in annual income? So it is, and as it is now under 5.609A, temporarily absent family members, we have a specific inclusion of income from them. Well, the way 5.609 has been restructured, we're not so much focusing on what is income, but just more what is not income. So everything is income unless it is specifically excluded from income. Okay, let's see. Program participants frequently question why PHAs are counting gross rather than net income, and will we be clarifying the new definition of income applies to gross income? So yes, we will in our guidance make sure that it's clear that it applies to gross income. And again, it's everything is income unless it's specifically excluded. We've gotten a number of questions about the asset limitation, lots and lots of questions about the asset limitation, also about interims and how interims will be processed and how prior year, how to calculate prior year income. We know those are some of the more complicated parts of HOTMA. We are going to be covering those on part 2. And we've also gotten several questions about HUD's guidance. And we are coming out with a notice this summer. It's really helpful to get your questions as we're sort of like finalizing our portion of the notice. So very helpful to find out the things we need to make sure we're getting very clear in the notice. That notice is expected, as I said, this summer. And so trying to get that to you as soon as possible. But please tune in also to the next week's training where we're going to cover those topics of asset limitation, interims, and some of the other things that we've been getting questions about that we didn't cover today. Moving on to see, let's see, what other questions can I answer? Can we still count the cost of toiletries, paper products, etc., for zero income families if another family member pays for them? Is that considered a donation? So right, HOTMA has a specific exclusion, for in-kind donations of things like toilet paper and paper products. So no, that would not be something that would be included in income. Those sort of like household items that are donated would be excluded from income now. Okay, we had a question on, will part-time students receive the deduction that was only allowed for full-time students previously? So I think there's a little bit, I just want to make sure we're talking about the right thing. So full-time students are eligible for a dependent deduction of $480. And just want to be clear that that's only for full-time students, not for part-time students. But when we're talking about student financial assistance, that student financial assistance can be excluded for part-time or full-time students. So just providing some clarity there. Let's see. I think, Dan, you had a question that you wanted to answer. Were you able to find it? I can, I'm going to put myself on mute really quick so that my colleague Dan can answer a question.
And I will come off mute, so hopefully you can hear me. Hi, this is Dan 3. I'm in the Public Housing Management and Occupancy Division. One question that we had come in, thanks, Ashley. One question that we had come in through the chat during the session was, where can you find the passbook savings rate? This was relevant to asset income when that income must be imputed. Going forward, once HOTMA is effective, HUD will be specifying the passbook savings rate that must be used for calculating imputed asset income, and HUD will be publishing that passbook savings rate on its website on HUD user this summer. That will be published before PHAs are in a position where they need to start conducting reexaminations with effective dates of January 1st or later. And Ashley, I'll pass it back over to you.
Ashley, I just want to make sure you're not talking.
Okay, now am I back? Sorry, we had
Yes,
some
yes.
technical difficulties. All right. So let's see, where were we? Okay, are co-heads eligible for the elderly disabled deduction? So yes, the elderly disabled deduction is still, it's not changing in sort of the policy behind who's eligible for that deduction. If the head, co-head, or spouse is elderly or disabled, the family gets that $525 deduction for the whole family. Okay. So let's see. Let's see, so many questions. So, when will HUD update the 4350 handbook with these HOTMA changes? So, and we also got questions about the HCV and public housing guidebooks. So the first thing that HUD is planning to do is get a supplemental guidance notice out, which would be like a PIH housing joint notice to talk about all of the HOTMA changes. And then we will update the guidebooks and the handbooks to match those notices. So at first, you're going to get a big notice that'll have like everything you need to implement these policies. I also saw a question on, does HUD have a list of like all of the discretionary policies that PHAs need to set? And yes, we are working on that, and we're trying to get that posted even before the guidance notice is available. So look out for that very soon. Hopefully in the next month, we can get that up with just sort of like a cheat sheet of all the discretionary policies that PHAs need to be thinking about making. Okay. We had another question, is the elderly disabled deduction for HCV also 525 instead of the 400? And that is correct. So it's 525 now, not 400. We have a lot of questions in here about really specific types of income, and we'd want to look at those a little bit more carefully before answering on the spot. But this is really helpful for us to get those types of income that you're interested in hearing more about, whether or not they would be excluded. So I think we could follow up and include those in an FAQ that we publish so that we can address sort of all those very specific types of income that might need a little bit more research than I can do right now on the line. So hang on, cruising through these questions. And I see a question about, whether or not HUD can develop verification forms for all of these, new things. We are working, to try to provide through the help of TA providers some sample forms. Certainly our notice is, we're planning to include a self-certification of assets because we know that's going to be a big one. And so we're going to try to provide as much support as we can in terms of like updated forms and policies. I see a question for an IRA account for people over 72. Will they be required, that they have to have a drawdown? Would that be considered income? So yes, distributions from retirement accounts are considered income. But the retirement account itself is excluded from net family assets. So, we're going to get to the asset limitation next week, but the retirement account value would not be considered in the family's net family assets for the purposes of like determining asset limitation and so on. So let's see. Yeah, okay. So we also see quite a few questions about what's the threshold for health and medical expenses for new families that, or, families that aren't already deducting those expenses as of January 1st, 2024, when HOTMA becomes effective. And the answer is that yes, it would be 10%. So the phase-in is just for those families that are already getting it. They have the 1 year at 5% and the 1 year at 7.5%, and they go up to 10%. So then also there is a general hardship relief of the 5 that you could be at 5% if you're, having a hardship where you're having, another circumstance. I think the language is inability to pay rent as well. But I have to look exactly at what that says, but that 5% is also available, and that would be available for anybody that was experiencing a hardship. Okay. I've seen a couple of questions about the, whether looking for work is a sort of eligible reason for deducting a childcare deduction, and that is still. And so the way the language actually hasn't changed in the rule from before HOTMA to after HOTMA, and so we're having the same interpretation, which it's working, looking for work, or going to school. Those are all eligible reasons for the child care deduction. So the only difference in the child care deduction is that now families can continue to receive it as a hardship if they have an inability to pay rent as a result of not having the child care expense deduction. Okay. And yeah, a lot of these we're working on guidance, trying to get something out for you guys, and it's really helpful to see all your questions. And so, thank you so much for all of these questions. We're going to, even though we can't answer all of them live today on the air, we will be following up and providing answers either through guidance or FAQs. I don't know if we've already, I think we'll at the end be posting our HOTMA questions at hud.gov email address. And that's, a great resource that we are monitoring every day to make sure we get your questions answered.
Great, thank you. So before we end, I want to remind everybody to go to HUD Exchange, HOTMA Income and Assets Training Series web pages. There you'll find the related resources for the trainings, including recordings of each of the live trainings, as well as the slide decks. For this training, you'll find Income and Assets Fact Sheet, Income and Income Exclusions Resource Sheet, Student Financial Assistance Resource Sheet, and Hardship Exemptions Resource Sheet, which is geared to both PHAs and residents, as well as the income estimation tool and directions. All registered participants for the live training will receive a follow-up email with a link to these resources.
Thank you to everyone for participating. I want to remind you to register for the final training, if you have not yet done so, on changes relating to income and assets that will be held on May 16th. That training will cover the asset limitation, asset exclusions, calculation of income from assets, de minimis errors, and interim reexaminations. And again, please send any follow-up questions on this training to hotmaquestions@hud.gov.